Chill guy here. Lock in with me for a minute. Turn off every distraction, close every tab, because what I'm about to show you will completely change how you understand what's happening in the silver market right now. This isn't speculation. This isn't theory. This is documented action from one of the biggest economies on Earth. Action that exposes a crisis so serious that regulators were forced to step in with emergency measures. And if you don't understand what this intervention actually means, you're about to misread the loudest signal the precious metals market has given us in over a decade. Right now, silver is trading at $85.15 an ounce. Gold is sitting at $4,918. And before we go any further, you need to understand something. These prices are not the ceiling. They aren't even close to fair value. They're the battlefield where control is being fought over in real time. Because while you were watching charts and checking your portfolio, something unprecedented just happened. The Chinese government, without warning and without apology, shut down 5 separate commodity funds in a single trading session. Not for minutes, not for a cooling off break, a full trading suspension. Their only silver futures fund available to mainland investors was locked for an entire day. 4 oil-focused funds were frozen at the same time until further notice. This wasn't maintenance. This wasn't a glitch. This was an emergency response to what regulators openly described as systemic risk and imminent massive investor losses. And here's what makes this moment different from the usual interventions. This is the second emergency shutdown in 8 days. Whatever they thought they fixed on January 22nd clearly didn't hold. The problem came roaring back so hard they had to slam the brakes again. When the second largest economy on Earth starts triggering emergency trading halts because commodity demand has spiraled beyond their control, you don't get to shrug it off as regulators being regulators. You don't get to say China being China, because what's happening there is a direct reflection of pressure building everywhere, and that pressure is about to spill into new outlets. I'm going to show you exactly what those outlets are, and more importantly, how to position yourself before the next phase detonates. But before we break down what this means for your wealth, if this kind of deep, no-fluff breakdown is giving you clarity you're not getting anywhere else, tap like right now so more people actually see it. And subscribe if you haven't already, because what's coming in February is going to separate the prepared from the blindsided. Now let's walk through exactly what happened, because the details tell the whole story. On January 30th, Chinese financial authorities executed what can only be described as coordinated emergency suspensions across multiple commodity investment vehicles. The biggest target was the UBS SDIC Silver Futures Fund. This isn't some tiny regional product. This is the only public fund in all of mainland China that directly invests in silver futures. The only one. Think about that. 1.4 billion people effectively have one regulated option for silver futures exposure, and that option gets shut down for an entire trading day. That's not routine market management. That's panic containment, and it gets worse. At the exact same time, 4 oil-focused listed open-ended funds were hit with synchronized suspensions, frozen until 10:30 a.m. Beijing time. The coordination is the tell. When regulators move on multiple funds at the same time across different commodities, they're not responding to a small isolated problem. They're responding to a systemic breakdown. So what broke? What forced their hand? Premiums. Specifically, the gap between what investors were paying for fund shares versus what the underlying assets were actually worth. And the numbers are insane. The UBS SDIC Silver Futures Fund was trading at a 36% premium to net asset value. Let me say that again so it lands. Investors were paying 36% more than the actual silver futures were worth just to get exposure through that fund. Here's what that means in real life. If you bought shares at that premium and silver futures didn't move at all, you'd still be staring at an immediate 36% loss the moment that premium normalized. You weren't buying silver, you were buying desperation. You were buying fear of missing out at any price. Chinese retail investors were so desperate for silver exposure they were willing to pay more than a third extra just to get in the door. They weren't asking what silver was worth. They were asking how fast they could get positioned before it ran away from them. Regulators saw exactly where that was going. They watched retail money piling in at mathematically unsustainable prices. They watched the feedback loop form. Premium rises, people interpret it as confirmation, more buyers rush in, premium rises again, even more momentum chasers jump in. That's the spiral they decided to stop before it burned the entire retail investor base, not because they hate metals, not because they're trying to kill the rally, but because when that premium collapses, and it always does, those losses would be catastrophic for millions of people who didn't even understand what they were actually buying. Now here's the question almost nobody in financial media is asking. Why was demand that extreme in the first place? Why were investors willing to pay 36% premiums instead of just waiting? Because the answer exposes exactly where we are in this cycle. Silver has been on an absolute tear. In the last 30 days alone, silver surged 58%. not 5%, not 15%, 58%. We're talking about prices pushing toward $118, $58 an ounce at the peak, levels that would have sounded delusional just 6 months ago. Gold has been running hot too, up 22% and approaching $5,600 an ounce. Oil broke resistance with Brent hitting 5-month highs above $70 a barrel. That's not random. That's not sector rotation. That's a coordinated stampede into hard assets, driven by forces accelerating, not cooling down. First, monetary policy chaos. Central banks have been whipsawing markets between cuts are coming expectations and higher for longer talk. Every time traders price in easier money, the dollar weakens, real yields compress, and metals catch a bid. Every time hawkish comments return, you get violent pullbacks. That back and forth creates extreme volatility, and leveraged fund products amplify it. Second, geopolitics. U.S. naval positioning near Iranian waters, tensions across multiple theaters, supply chains feeling vulnerable. When traders start pricing conflict risk into oil and investors start hedging currency debasement through metals, demand surges fast enough to overwhelm normal market infrastructure. Third, the structural supply crisis. Nobody is connecting to spot prices. Silver isn't just monetary, it's industrial muscle. Solar panels consume it, EVs consume it, 5G infrastructure consumes it. The green transition is silver intensive, and supply has not kept up with demand growth. When monetary demand, safe haven demand, and industrial demand all hit at once, you don't get calm price discovery. You get violent moves. And when that demand is funneled through one single vehicle serving 1.4 billion people, you get 36% premiums and emergency halts. Now, I want to prove to you this is not isolated to China. The gold-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has compressed to its lowest level since 2011. That's not happening because gold is collapsing. It's happening because silver is catching up hard, and historically, that kind of compression signals a major regime shift. At the same time, physical silver demand has been exploding globally. One major dealer reported a 158% increase in sales of 1OZ silver coins and a 550% increase in demand for 1 kilogram bars over the same period. Google searches for how to buy silver and buy silver online spiked 250% in recent months. That's not niche interest. That's mass awakening. People are looking for exposure outside the traditional system, and physical accumulation is one of the clearest expressions of that. So when Chinese regulators shut down their only silver futures fund, that demand doesn't vanish. It redirects. Some flows into physical silver, some moves into Hong Kong listed products, some shifts into gold, some finds pressure points in international markets. This is the critical point everyone misses. The halt didn't kill demand. It forced demand to find new routes. And every new route creates more pressure on global supply chains that are already stretched thin. Now let me show you the smoking gun that proves the bigger setup. Normally, if a market gets halted or spooked, shorts swarm in, funds smell blood, algorithms pile in, borrow demand spikes, borrow costs rise. But right now, the borrow fee for SLV, the world's largest silver ETF, is basically zero, rock bottom. And there are millions of shares available to borrow just sitting there. Nobody wants them. Nobody's shorting. Do you realize how insane that is? China just triggered emergency halts. The narrative should be, the rally is done, regulators are shutting it down, the trade is crowded. And yet, the smart money refuses to bet against it. Why? Because they're staring at the same data we just walked through. The 58% move in 30 days. The physical demand explosion, the structural supply deficit. Chinese demand being redirected into other markets. They know shorting silver here is like stepping in front of a freight train and holding up a paper sign that says, stop. That freight train is global demand for hard assets, and if you stand in front of it, you don't get rich, you get erased. And this tells us something else. Any weakness we're seeing isn't natural selling. It isn't institutions dumping. It's pressure from a small handful of bullion banks dumping contracts to keep price contained, leaning on paper leverage to cap silver and defend dollar credibility. But they're alone. And the rest of the financial world is standing back because they understand this $85 price is not a ceiling, it's a coiled spring. And the moment that suppression loosens, arbitrage wakes up and the price can gap violently higher. Now we need to talk about the oil side, because it's connected to silver in ways most people completely miss. China didn't only suspend the silver fund, they hit 4 oil-focused funds at the exact same time. That coordination is the tell, and on the same day those suspensions hit, Brent crude broke above $70 a barrel for the first time in 5 months, while U.S. naval vessels were positioning near Iranian waters. The market was pricing geopolitical risk premium directly into energy. Chinese investors chased it through oil funds the same way they chased silver. Here's the loop regulators were trying to break. Tensions rise, commodities rise, retail chases, premiums expand, premiums become unstable, regulators intervene. But here's the part nobody wants to say out loud. That intervention treats the symptom, not the cause. Tensions are still there. Supply vulnerabilities are still there. Demand is still there. Halting trading for an hour doesn't remove those forces, it just compresses them temporarily. That's why I believe the oil story isn't close to done, and why it validates the precious metal story. Because both are being driven by the same underlying force: loss of confidence in paper systems and flight into physical assets. Think about what oil and silver share: strategic importance, essential infrastructure use, vulnerability to disruption, and paper markets where contracts massively outnumber physical delivery capacity. When stress hits those systems and demand surges faster than supply can respond, people start questioning whether their paper exposure will actually convert into physical reality when it matters. That's when premiums explode. That's when funds trade 36% above NAV. That's when regulators panic. But shutting down trading doesn't create more oil. It doesn't create more silver. It just hides the supply crisis behind regulatory curtains. And here's what comes next. Pressure builds. Demand finds new routes. Premiums pop up somewhere else. Hong Kong, Singapore, London, wherever capital can move. We're already seeing it in physical premium data, in the gold-silver ratio compression, in the refusal to short even when the headlines scream chaos. The smart money understands what regulators don't want to admit. You can halt trading, restrict purchases, and impose cooling periods. But you cannot suspend the forces driving demand, and you cannot manufacture physical supply with paperwork. So when I look at China's intervention, I don't see the end of the commodity rally. I see confirmation the rally is strong enough to threaten systemic stability, and that tells me we're not near the top. If we were near the top, regulators wouldn't need to intervene. Weak hands would be selling naturally. Premiums would compress on their own. The market would find balance without emergency measures. The fact they shut down trading twice in 8 days tells you the opposite. Demand is so relentless that normal mechanisms can't handle it. And when normal mechanisms can't handle demand, demand doesn't disappear. It gets more creative. Now I want to address the elephant in the room because I know some of you are thinking it. Yes, silver has momentum. Yes, fundamentals support it. Yes, China's halt shows real demand pressure. But markets that run this hard this fast can also correct sharply. The same volatility that creates 58% gains in a month can create 30% drawdowns in a week. Some analysts are projecting $150 silver within 3 months. That might happen. But it's also the kind of aggressive target that tends to appear when retail enthusiasm is peaking. I'm not saying sell everything. I'm not saying the rally is over. I'm saying understand where we are. The easy money has been made. The obvious trade has been executed. What comes next requires more discipline, more patience, and more risk management. If you're already positioned, this might be a time to focus on protecting downside rather than adding at extended levels. If you're not positioned, this might be a time to wait for pullbacks instead of chasing momentum at 52-week highs. Real wealth in these markets is built by the people who buy fear and sell greed. And right now, there's a lot of greed in silver. That doesn't kill the bull run. It just means the next phase requires more skill than the first. But here's what I want you to understand about China's intervention. This isn't the end of the story. It's the beginning of a pattern. When markets get hot enough to threaten stability, regulators step in. They halt trading. They restrict new buys. They do what they think prevents retail from blowing themselves up. That doesn't mean the trend is wrong. It means the trend is strong enough to scare them. And strong trends usually have more room to run once intervention pressure eases. History is full of this. Major precious metals bull markets repeatedly saw attempts to cool price action. The 1970s had multiple intervention moments. The 2000s run had similar behavior. Interventions created pauses, but they didn't erase the underlying forces. I'm not saying history repeats perfectly. I'm saying intervention during a strong bull market is normal. So if you're using China's halt as your reason to panic sell, you might be reading the signal backwards. Let me give you a framework instead of a prediction, because frameworks keep you alive in volatile markets. 1. China's halt is a signal, not an endpoint. It tells you demand exceeded the system's capacity to process it smoothly. That demand redirects, builds pressure, and eventually releases. 2. Premiums are information. A 36% premium is the market screaming desperation and constraint. You don't need to trade the fund to respect what the premium is telling you. 3. Separate trading from accumulating. If you trade short-term, don't chase. Wait for pullbacks. Don't pay premium for exposure. If you're accumulating long-term, volatility matters less. You're buying the decade-long thesis of debasement, industrial demand, and hard asset repricing. 4. Watch the physical market. When paper access gets disrupted, physical becomes more attractive. Dealer premiums are information. Rising premiums tell you the physical market is tightening. Falling premiums tell you supply is catching up. And right now the physical market is screaming. Dealers are reporting demand patterns that look like panic buying. 158% growth in 1O's coin sales, 550% growth in 1 kilo bars. And this is happening at the same time China is blocking paper access. That means some capital is being forced into channels that are harder to suppress. Physical metal doesn't have trading halts. Physical metal doesn't have a fund manager who can block your buy button. Physical metal is the escape hatch. That's why watching dealer premiums matters. When premiums rise above spot meaningfully, it signals paper price is disconnecting from physical reality. It signals people are paying extra to secure real possession. We're starting to see that in certain markets, not everywhere, not evenly, but the trend is forming. And if Chinese demand continues moving into physical routes, those premiums can expand further. That creates a loop regulators can't stop. Restrict paper, demand moves to physical, supply tightens, premiums expand, premiums validate the paper is artificial narrative, more people rush to physical. You can't regulate your way out of a supply crisis. You can't suspend your way out of demand, and you can't undo decades of underinvestment in mining while industrial consumption accelerates. 5. Watch the gold-silver ratio. It's one of the most reliable cycle signals in this entire sector. It's in a powerful reversion phase right now, and whether it continues or snaps back tells you a lot about where we are. Now, beneath all this volatility, here's what I think is really happening. This is a stress test of global commodity infrastructure. Geopolitics, monetary confusion, and structural demand growth are pushing markets beyond what they were designed to handle. China halting funds is one response. Other countries may respond differently, but the underlying pressure is the same everywhere. And pressure like this tends to produce the same long-term outcome: repricing. Paper assets that used to feel safe start to feel fragile. Hard assets that felt old school start to feel essential. Fiat currencies that felt stable start to feel experimental. Physical commodities that felt boring start to feel strategic. That's not a prediction for next week. That's an observation about where we are in a multi-decade cycle shift. The people who recognize these shifts early position for generational wealth transfer. The people who dismiss it as noise get left holding devalued paper. So here's my question for you, and I want this in the comments. Do you think China's trading halt is a warning that silver ran too far? Or confirmation that demand is so strong even regulators can't contain it? There's no wrong answer, but your answer reveals how you're reading this moment, and that shapes your positioning. Drop your thoughts below, and if you've been navigating this rally successfully, share what's working for you, because real-world feedback from this community helps everyone watching. Let me leave you with one final thought. When authorities intervene, they're telling you the market has gotten strong enough to scare them, and markets scare authorities when something fundamental has shifted. The forces driving precious metals demand aren't going away. Debasement concerns aren't going away. Geopolitical uncertainty isn't going away. Industrial demand isn't going away. Central bank gold accumulation isn't going away. These are multi-year themes, not multi-week trades. And if you're positioned for the long game, day-to-day intervention noise becomes a lot easier to navigate. Here's one more framework to lock this in. Markets move in cycles: bull phases, bear phases, consolidation, breakouts. Inside those cycles, there are patterns. Regulatory intervention is one of them, and it tends to show up at specific points. Early in a bull market, regulators don't care. Moves are small. Retail is low. No systemic fear. But as the bull matures, prices accelerate, retail floods in, leverage rises, regulators pay attention. They see premiums expand. They see chasing. They see risk stacking. Then they decide, let it run and risk a brutal bust, or intervene now to contain damage. China chose intervention. They saw a 36% premium and basically said, this has gone too far. We need to protect retail from itself. That tells you where we are. Not early. The easy money is behind us, but not late either. If we were late, premiums would compress naturally, smart money would short, and weak hands would sell into strength. But that's not what we see. Smart money isn't shorting. Physical demand is accelerating. The gold-silver ratio says silver still has room versus gold, and Chinese demand is already finding alternative outlets. That's the middle phase of a major bull market, the phase where volatility increases, intervention ramps up, weak hands get shaken out, but the trend remains powerful. The people who build generational wealth are the ones who don't panic in the middle phase, the ones who separate noise from signal, the ones who understand intervention doesn't mean invalidation. China's halt isn't telling you to sell. It's telling you demand is strong enough to scare regulators. Don't confuse intervention with defeat. Don't confuse temporary halts with trend reversal. Don't let short-term noise steal your conviction when the long-term thesis is still intact. Chill Guy here, Friday, January 30th, 2026. Silver is at 85.15. Gold is at 4,918. China just shut down their only silver futures fund for the second time in 8 days. Physical demand is exploding globally. The gold-silver ratio is at levels we haven't seen since 2011. And smart money is refusing to short despite the chaos. If this breakdown helped you see through the noise, hit like, subscribe, and share this with someone who needs to hear it. Stay sharp. Don't let intervention noise shake your conviction, and I'll see you in the next one.